Let me just maximize it. Okay. So, wow, quite a turnout. Let me just give you a couple of minutes before everyone gets in. For us to have. Okay, I guess there's a question. When will the lecture slides be available on Blackboard for us to have? Oh, did I not activate it? Let me just double check. Maybe I forgot to activate it. Course document, lecture slides. Ah, I see. Make available. Okay, so I just activated chapter 3 lecture slides. So for those of you who wants to download the slides for today's lecture, you can go ahead, log into our Blackboard and download chapter 3 lecture slides that I'm going to use today. Okay. No problem. Okay. So I guess this is about it. So why don't we get started? Let me just. Oh my God. Okay. Google Forms. So just to pick up from last time, so one student asked whether we can have a networking session to get to know each other from the cohorts. And then I sent out the link for the survey. And although not everyone actually participated in the survey, but according to the results, let me just share what I got. So I got 25 responses. I want to show the names. So this is the distribution. So apparently more than 30% of your classmates do not really want to have a networking or introduction section. So given a large proportion of students not inclining to have that session, I don't think I can have that. So instead, what I can suggest for you is to, I'm going to, let me just log into the Blackboard. So what I'm going to do is to activate one folder, I guess, that says discussion board. So in that discussion board, maybe one or two students can introduce themselves and then maybe have a scheduled meeting on Zoom with your own Zoom link. So they, for any of you who wants to have a networking session with your fellow students, you guys can go ahead and coordinate yourselves to have a networking session. But given that I have about 32% of students not wanting to have a networking session during my class time, I cannot really go ahead and have that session. But again, if some of you still wants to know each other, I will activate a discussion board. It's like a thread where everyone can post their replies. So introduce yourselves, or if you want, you can have your own Zoom link and then maybe schedule a meeting yourselves to get to know each other. Okay, so okay, one of the chats says we would love a discussion board. So I'll go ahead and activate the discussion board. So it's a voluntary basis. I'm not going to force you to use the discussion board. I'm not going to force you to be in the scheduled Zoom meeting. But again, I understand that this is an MBA or master students. Networking is very important. Should be a really important part of your career. So, okay, so that's it. for the survey. And I don't have any other housekeeping items. Are there any questions? Will I join? I don't think I'm qualified to be joining in your Zoom meeting, but I mean, if a lot of you really want me to join the Zoom meeting, depending on the time, depending on dates, I might join. But again, it's your session, your time to get to know your fellow students. So if a lot of you still want me to join the Zoom meeting, I'm be glad to join the meeting. Okay. Any other questions before we get to today's lecture? Okay, I think that's about it. So we have 44 students. Wow, quite a turnout. So before we start chapter 3, let me just go back to chapter 2 and then recap what we learned from last time. So last time it was all about journal entries. It was all about measuring. It was all about the different types of transactions that that you need to be familiarized with in order to solve questions on the quiz and midterms. So like I promised last time, so this is the question that I posted on Blackboard dealing with an expanded accounting equation or the variations that we play around to in order to trick students. So why don't we get started? So we have a beginning balances for assets, capital stock, retained earnings. During the year, assets increased by 60, liabilities increased by 20, capital stock increased by 40. If the company recorded $10 of dividends and $90 of revenues during the year, compute the following. So ending balance of retained earnings. So so what we have is this. So let me just change that. So we have assets, okay? Let me just start with an accounting equation. So assets equals liability plus shareholders equity. The beginning balance, we have 100 for assets. We don't know the liability. So let me just put it as liability plus we know capital stock. Capital stock basically is common stock. So common stock, which is $10 plus retained earnings, which is $50. Okay, so in the beginning of the accounting course, we usually say shareholders equity equals common stock plus retained earnings. But in reality, there are some other items, additional paid in capital, preferred stocks. There are so many other items, but we're not going to consider that for now. But we know that shareholders equity equals common stock plus retained earnings. So from this equation, we can easily calculate the beginning balance of liability, which should be 40. Okay. Now, during the year, assets increased by 60, liabilities increased by 20, capital stock increased by 40. So during the year, assets increased by 60, so the ending balance will be 160. Liabilities increased by 20, so 40 plus 20 equals 60, plus common stock increased by 40. We started with 10, so 10 plus 40 equals 50, plus retained earnings. We don't know the retained earnings, ending balance, okay? So given this math, we can easily calculate what ending balance of the retained earnings, which will be 50, okay? So according to this, we had a beginning balance of retained earnings at 50. We have an ending balance at $50. So technically there is no change. So let's see what happens during the year. Okay, so we had beginning retained earnings at 50. So we know that retained earnings equals to net income minus dividends. Okay. So we had a beginning of 50, we had an ending balance of 50. So that means during the year, the change in retained earnings equals 0. Okay, so technically there's no change. So what that means that net income minus dividends should equal to 0. Okay, so according to the question, if the company recorded $10 of dividends, so we know dividends is 10, net income is revenue minus expenses. We know that the revenues was 90, so the expenses should be 80. Okay, so we're done basically. So let's go back to the question. What's the ending balance of retained earnings? We just calculated. So ending balance of the retained earnings is 50. Okay. B, net income for the year. So net income was basically, since there is no change in retained earnings, net income should equal to dividend. Dividend was 10, so net income is 10. Okay. C, expenses for the year, I calculated as follows. So expenses should equal to 80. Okay. So this was an example that we play around in order to trick students, in order to make questions more difficult instead of just giving you this. So we had $50 of assets, $20 of liability. What's the amount of shareholders' equity? I mean, this is a very easy types of question that we're never going to give you a question on. I think we had a question?
Yes. Why is net income for the year 10 when?
Okay, so the change of retained earnings was 0. Okay, so retained earnings is net income minus dividends. We know that dividends is 10, and therefore net income should equal to 10 in order to make 0 at the end of the day.
Okay, thank you.
Okay. Any other questions?
Can you just explain why you would make the change 0 instead of 50?
So the change is 0 because according to this, we had a beginning balance of 50 here. According to the question, we had a retained earnings of 50, okay? And after applying all the changes that happened during the year, we calculated that the ending balance of retained earnings should equal to 50. So we had beginning 50, we had ending 50. That means during the year, the change in retained earnings should equal to 0. Okay. Any other questions? Okay, so I mean, these are types of questions that you can expect during the exam and during the quiz, especially on the midterm and then first quiz. So you should definitely be prepared to be able to solve these types of questions, okay, in about 3-4 weeks. Okay. So if we don't have any other follow questions, I'm going to move on to the next question. Question 6. So this is a quite similar types of question. At the beginning of the year, assets were 50, liabilities were 20, capital stock was 5. During the year, assets increased by 70, liability decreased by 5, retained earnings increased by 40. Dividends paid during the year were 10. If expenses during the year were 80, compute the year's revenues. So there are so many numbers that are going around, but if you pay close attention, so the purpose of the question, or what the question is asking, is the amount of the revenues. So let me start from the bottom instead of going from the top. So I'm not going to use this equation to begin with. So let me show you this. So we have no, I'm not going to use net income. So we know that retained earnings equals net income minus dividends. Okay, so according to the question, retained earnings were increased by 40. So we show that there was an increase by 40. We don't know net income, but we know that dividends paid during the year were 10. Okay, so what that means is that during the year, the company reports a net income of 30. Okay, so if net income,
Professor, you mean 50?
oh yeah, sorry, very good catch. So 50. So we know that net income during the year is 50. Now the question says expenses were 80. So what that means is that we have revenues minus expenses. According to the question, expenses were 80. So we can easily calculate the revenue, which should be 130. Okay. So, I mean, there are so many numbers that are given, but you don't actually need to use all of the numbers that are provided to you. They are just there to confuse you. They're just there to trick students during the exam. So again, I'm gonna give you a bunch of questions. Like I'm expecting between 75 to 100 questions for a approximately 3-hour exam. So you need to be very careful with respect to the time management for the upcoming midterm. So I mean, given this question, there are so many numbers that you can play around, but you don't actually need to use all of these numbers. What you need is just the changes in retained earnings, dividends, and expenses. That's it. You didn't really need to use these numbers.
So are these types of questions, I did some of the problems in the back of chapter 2.
Uh-huh.
Are these problems in chapter 3?
Yeah, of
Okay.
course.
All
Yeah.
right.
But it'd be more complicated.
Yeah,
Definitely.
okay. Chapter 2 was pretty simple, but this is chapter 3 work, basically.
This is like 2.5. Like chapter 2, in between chapter 2 and chapter 3.
Fine.
Okay. But as long as you know this accounting equation, as long as you know the expanded equation, you are pretty much in good shape. I'm just showing you the fact that given the importance of time management, you need to be able to pick the numbers that you are going to use in order to answer the questions.
Yeah, but are some of those more of those in the solutions part of chapter 3, the additional questions in the book?
Come again?
Like variants of this, if
Mhm.
you go to chapter 3 and look in the back of the chapter.
I mean, actually, this is more devoted to chapter 2 instead of chapter 3. Chapter 3 is more about the adjustments. It's more about preparing financial statements. This particular question is more about this accounting equation, which was the focus in chapter 1 and 2. So, I mean, it touches upon a little bit of chapter 3, but more on chapter 2.
Okay, thank you.
Any other questions? Okay, so I get 2 more questions. So according to this, this is straight from the textbook. So this company incurs the following transactions for September. So let's dig into what the question is asking. 3rd slides. So on September 3rd, the company paints houses in the current month for $20,000 on account. So the question is asking, prepare journal entries for each transaction and a general ledger and trial balance. So basically this covers everything that we discussed from last week. So let me start recording journal entries. So first transaction, the company basically is providing a service for the amount of $20,000 on account. So what that means is that since the company is providing service, you are going to be recording a revenue or service revenue for the amount of $20,000. Since this was made on account instead of for cash, you are going to be recording accounts receivable with the same amount, $20,000. Okay, so first line is usually the debit line. Second line is usually for the credit line. Okay, so debit accounts receivable, credit service revenue for the amount of $20,000. Okay, but easy stuff, right? But stop me anytime if you are confused. with anything. Number 2, on September 8th, the company purchased painting equipment for $21,000 cash. So basically, this is an equipment which is an asset. So when there is an increase in the assets, you are going to debit it. So equipment for the amount of $21,000. Since you're using cash or spending cash to acquire the equipment, you're going to credit cash $21,000. Okay, so by this point, you should be very comfortable with writing journal entries on the debit side and the credit side. This requires a lot of practice and requires a lot of exposures to various types of transactions. So I really strongly encourage all students to practice as much as you can. In the text, and then there are so many questions in the textbook that you can basically take advantage of. So practice, we know that practice makes perfect. Number 3, the company purchased office supplies on account for $3,500. So supplies are assets. So when there is an increase, you're going to debit supplies for the amount of $3,500. You're using your credit card on account. So you're going to be recording liability accounts payable for the amount of $3,500. Okay, so this is an assets and this is a liability. Okay. Number 4, transaction. The company pays employee salaries of $4,200 for the current month. So when you incur salaries to be paid, you're going to be recording salaries, expenses for the amount of $4,200. Since you're paying salaries, you're going to be using cash, $4,200. Okay, so easy peasy, hopefully, everyone. Number 5.
Professor, I have a quick question.
Go ahead.
For 3 and 4, we're not writing debited or credited, or is that just to be like understood?
You mean this types of indicators?
Yeah.
I mean, as long as you indent to the right for enough space, I can easily identify whether this is a debit journal entry or credit journal entry. But you're more than welcome to use these indicators if that makes you easier to understand. But for me, I mean, I'm so used to the journal entries, I just tend to not use these identifiers whenever I write journal entries. But on the exam, do you think? No, I don't think this writing DR or CR is required.
Okay, thank you very much.
Okay, so make sure that you indent enough space to indicate that you are writing a credit side. Okay. Number 5, the company purchased advertising to appear in the current month for $1,000 cash. So advertising, so you're spending cash to basically advertise your items. So you're going to be recording advertising expenses for the amount of $1,000. The company used cash, so you're going to be crediting cash by $1,000. Number 6, the company pays office rent, so rent expense. Okay. Expenses are debit account items. The amount is $5.4K, and you're paying for rent, so you're going to be spending cash with $5.4K. Okay. 7, the company received, cash. So when you receive cash, you are going to be debit cash with $15K. What are you receiving the cash for? From the number 1 transaction, which was the accounts receivable. So you had some receivables back in September 3rd, and on September 26th, you're actually receiving cash. So you're going to be crediting accounts receivable by $15K. Okay. And last item is the company received cash of $6,000. So again, you're going to debit cash, $6,000. in advance from a customer who plans to have his house painted in the following months. So this is a typical example of deferred revenue or unearned revenue. So instead of recording a revenue, you are just receiving cash in advance for the services to be performed in the following period or in the next months. So what you're going to be recording is deferred revenue for the amount of $6,000 or sometimes unearned revenue, okay? And keep in mind that this, even though it says revenue, this is actually a liability account item, okay? So these are all the journal entries the accountant will going to record throughout the period. Now, let's move on to the general ledger. So I explained this last time. When we say general ledger, is basically a summary. Ledger is a summary of my handwriting. It's a summary for each accounting item. Okay, so let's start with cash. So you have cash. Let me go down a little bit. On the left side, it's usually the debit items. On the right side is credit items. So let's go up. So according to the first transaction, we don't have anything related to cash. Number two, yes, we are decreasing or crediting cash for the amount of $21,000. So I'm going to be recording $21,000 on the credit side. Let's go to number three, transaction. Number three, there is no cash. Number four, yes, we have cash. So we have a credit item of cash for the amount of 4.2K. So I'm going to be recording 42 here. Let me go up a little bit. There was 4. Number 5, we also have cash transaction here. So decrease of cash by $1,000. So again, another credit of $1,000. Numbers, do not move. Number 6, another decrease of cash by $5,400. So $5,400. Number 7 and 8. For number 7 and 8, we have both an increase for cash by $15,000 and $6,000. So we're going to be recording $15,000 and $6,000. Okay, so this is basically the general ledger item for cash. So at the end of the day, we have a total of 21 increase. And let me just do quickly math. So 25.2, 55.3, 30.7. Okay, so we have a decrease of 30.7. So it's just $30,000 and $700. So
Okay.
at the, what was that?
Isn't that 1,000, not 100? So it would be 26.2.
Is it 100 or 1,000? Let me just make sure. So it's 1,000. Let me go back. So it's 1,000 cash.
Right. So
Okay.
it would be instead of.
Oh yeah, you're
25.3,
right. Stupid. I made a mistake. Terrible mistake. Okay, so 25.k, 26.2, 31.6. So we have a decrease of 31,600. So at the end of the day, we have a decrease of 10,600 of cash. So there is more outflow of cash during the period. Okay. So basically, this is the general ledger for cash. And you can do the same thing for deferred revenue, accounts receivable, rent expense. Let me just show you one example for accounts receivable. So for accounts receivable, we had according to number 1 transaction, an increase of accounts receivable for $20,000. Okay, so if we have an increase of an asset, we record here on the left side. And then during the year, the company had not had anything to do with accounts receivable except transaction 7, when we recorded a decrease in accounts receivable by $15,000. So we are going to be recording a decrease of $15,000. So at the end of the period, we have an increase of accounts receivable by $5,000. Okay, so this is a typical example of general ledger account for individual line items. Okay, and you can do the same thing for deferred revenue. You can do the same thing for rent expense, advertising expenses, salaries expenses, and supplies. Okay, I'm not going to go through every line items because I don't see the point of doing it, but basically this is it, general ledger. Okay.
Question.
Yeah.
What's the difference between T account and general ledger? Because I thought those were T accounts.
Yeah, these are T accounts. So basically, general ledger. So this is T account, but when you actually get into the like an official general ledger, you're going to be seeing something like September 3rd or September 5th. All these types of details. But basically, general ledgers are similar to T accounts. Okay. Any other questions? Okay. What about the trial balance? So basically, trial balance is basically putting all items based on the debit and credit side. Okay, so we have here debits and credits. Let me just, why not? We have debit of $15,000, $6,000 for cash. We had a credit of $21.42, $21.42. If my memory serves well, we had 1,000 on the credit side, and we had 5,400. That was for cash. Now we had accounts receivable 20,000 debit side, 15,000 on the credit side. We have 20,000 on the debit side, 15,000 on the credit side. So basically, you're listing all the debit items and then listing all the credit items regardless of each accounting items. And at the end of the day, the total amount of debit balance should equal to the total amount of credit balance. That's it for the trial balance. Okay. Any questions?
Yeah, just a question. So like these kind of situations, right? Like obviously in the real world, would they have like software to kind of keep?
Oh, of course. I mean, we're doing it manually, but in the computer, yeah, of course. I mean, it's gonna pop up an error message, for example, saying that the balance do not match, or there's some problem with your transaction, for example. Yeah. Yeah. I mean, here, QuickBooks is a great example. Any other questions? Okay, I think we're good. What is this? So again, this is straight from the textbook. The question is asking from the table below, select the most appropriate explanation for each transaction. So what the question is asking is this. So far, we are given a transaction. For example, on September 3rd, we bought supplies for the amount of $300. What's the journal entry? Now, for this question, it's like a reverse engineering. So given the journal entry, you have to use your imagination to think about what had happened at that period. So let me, for example here, so let's use number 1. So number 1 says, we are recording a debit of cash, okay, a debit of cash by $20,000. And according to this, service revenue, we are crediting service revenue by $20,000. So given this journal entry, what do you think that has happened? I mean, it's very easy. The company provided service, and that's why the company is recording a revenue, and as in return, the company received cash. Okay, so I mean, briefly, the company provided service to a customer and received cash. That's it. So again, this is basically a reverse engineering. Given the journal entry, what do you think had happened? That's basically it. I'm not going to go over everyone, but why don't we do number 6? Number 6 sounds a bit complicated. So according to 6, we are debiting accounts payable by $7,000. And where can we see? And then we can see cash side, not credit, cash. Okay, 7,000. So given this journal entry, my assumption is that the company is using cash to reduce the payables. So obviously, before the company bought something on account, okay? If the company bought something on account, there will be an accounts payable. And later, the company is actually paying back, okay? So the company is actually use cash to pay off basically a debt owed to a vendor, for example. Okay, so that's why you are debiting accounts payable, which is the liability. So it's basically reducing a liability by spending your cash. Okay. Any questions so far?
Yeah, just a quick question. I sometimes get confused with I guess salary expense and salaries payable. So I guess the biggest difference between those two is the fact that salary expenses is what you pay, and then salaries payable is what you owe that you haven't paid yet, right? Just because that's one of the things that definitely when it comes to homework, it just gets a bit confusing for me.
Now, yeah. So basically, that's something that we're gonna learn today. But let me just provide you briefly. So basically, I mean, in the real world, you're not gonna get paid as an employee. You're not gonna get paid in the same period. You usually paid in the next period, right? So let's say this is I don't know why this do that. November, December. Some companies use bi-weekly, sometimes use monthly, but assuming that we're following a monthly basis. So for the months of November, basically employees work for you. And during the period, you're going to be recording salaries expenses because they are working for you, you're incurring salaries. That is to be paid in the next period. So during November, what you're going to be recording is this. In reality, salaries, expenses, and on the credit side, salaries, payables. Okay. So far in chapter 2, we usually put cash because assuming that the company pays for salaries in the same period, but in reality, that's not the case. So instead of recording cash, you record salaries, payables, okay, during November. And when December comes, you are going to be debiting the exact salaries payable and then spend your cash to pay off.
Okay, so cool. So in this scenario, you debit salaries expense, credit salaries payable, and then afterwards you then what's it called? Debit salaries payable, credit cash.
Yeah.
Okay, cool.
So this more reflects to what really happens in the real world. Again, companies in the real world, companies not really pay your salaries in the same period. they usually pay in the next period. So this is more a reflection of what really happens in the real world. But as an introductory course in chapter 2, we assume that the company just pays cash in the same period. And that's why some students were confused. But any other questions?
Professor,
Yeah.
for the salaries expense and salaries payable, so what's the journal entry will be in this case?
Journal entry,
Yeah, what it gonna say is like the company. I don't know what it's gonna say. So.
I mean, journal entries.
Or it's not recorded, or I don't know.
I mean, given this example, the journal entry is this: debit salaries, expenses. For example, let's say $50, and you're going to be recording a liability called salaries payables for the amount of 50. Okay, and during December, when the company actually pays for the salaries that you owe to employees, you're going to be recording a debit of salaries payables. Okay, so basically debiting a payable, you're reducing a liability, and you're using your cash to pay off the liability. So these are the series of journal entries.
I mean so December is gonna say company paid salary like using cash, but what they gonna say in November?
In November?
Yeah, it's gonna say company will pay the salary. Like
you mean
for this
I mean,
transaction.
I think you're asking me the language that we describe the transaction. Oh, well,
description.
What are some of the examples? Let's say the company incurred salaries that is to be paid in December, for example.
Okay.
We are going to be very specific when we are asking questions.
Okay.
Salaries are paid in arrears, is what I think they say.
Okay.
Yeah. I really
Thank you.
But that's basically the language that you will see during the exam. Okay. Any other questions? Okay. So this was the review for chapter 2 mostly. So basically, at the point of transaction, what journal entry are you going to be recording, and what is going to be like for journal ledger, and what is going to be like for trial balance. That's it. Moving on to today's lecture. Do I want to save this? No, I don't want to save this. So chapter 3. So chapter 2 was mostly about what happened during the period. Chapter 3 is more about the adjustments, the changes, or the updates that you're going to be recording at the end of the period. Okay. So when we say the accounting cycle, usually January 1st to December 31st. So during the year, there are going to be a lot of transactions. For example, you're going to be buying supplies, you're going to be paying salaries, you're going to be potentially buying inventory on account or paying something on account. So there are going to be a lot of transactions that you're going to be recording that you learned from chapter 2. Now, for the chapter 3, at the end of the year or at the end of the period, the focus is this: the adjusting entries. I mean, what you're going to be recording as an adjustments or updates or the changes from the previous transaction. That's the focus. And then after making those adjustments, I'm going to be teaching you how to prepare the financial statement, mostly on the income statement and the balance sheet. And lastly, we're going to be learning the closing process or the closing entries. Okay, that's the sequence that we're going to be following for chapter 3. Now, the reason why there are adjustments or the reason why there are changes in the journal entries is the fact that we are following this accrual accrual basis of accounting. Okay. Now, if we are following cash basis of accounting, it's very easy. When you receive cash, you're going to be recording an asset or revenue. When you spend your cash, you're going to be recording an expense or liability. But since we are following an accrual basis of accounting, there are cases where you have to make an adjustments. For example, let's say the company performed service, okay, service on March 4th, okay, on account. If we are following cash basis, that means you're going to be recording a revenue on March 4th, okay? But since we are following an accrual basis of accounting, okay, we are, I made a mistake on account. Let me, so basically we are recording a revenue, but at the same time, we're recording an accounts receivable at the same time on March 4th. Okay, that's right. So, I don't want to, let me scratch that, make it more clear. Let's say you are receiving cash in advance, okay, for services to be performed in April, for example. By the way, you're receiving cash in March, okay? If you are following a cash basis of accounting, you're going to be recording a revenue on March, okay? Because according to the cash basis, the timing of the recording for revenues is when you actually receive the cash, the physical cash. But when you are following an accrual basis of accounting, you are only going to be recording a revenue in April because you have not performed the service. So in order to, so like we discussed last time with respect to Tesla, the timing of recording a revenue was upon the delivery of the vehicle. So if we follow the accrual basis accounting, you're only allowed to record a revenue upon completing or upon fulfilling the obligation that you provide a service. So basically, in March, you have not performed the service. That's why you're only recording a revenue in April when you actually perform the service. But according to the cash basis of accounting, you are going to be recording a revenue in March because that's the point when you actually receive the physical cash. So because of these two types of accounting principles, cash basis and accrual basis, there are going to be differences in timing, and that will cause a difference with respect to recording and adjusting entries. Okay. Now, you might be asking, according to the US GAAP, which one should you follow? Definitely, accrual basis accounting is the rule that you have to follow. Okay. Any questions? Okay. So, let me move on to the next slide. So for the first learning objective, you have to understand when revenues and expenses are recorded. So we're talking about the timing of when you record a revenue or expenses. Let me, hold on, hopefully. Okay, so revenue recognition. So companies record a revenue in the period when goods and services are provided to customer. Okay, and we talked about this last time using Tesla. So again, Tesla only records the revenue upon the delivery of a vehicle. Tesla does not record a revenue upon signing a contract or paying a down payment to a dealer. Tesla only records the revenue when they actually fulfill the service, which means you are actually delivering a vehicle to a customer. Okay. Expenses are pretty similar. Any cost used to help generate revenues are recorded as expenses in the same period as those in revenues. So what that means is that you are usually going to record an expense when you report a revenue. Okay. So for example, let's say you sell something. You sell inventory in November. Okay. Actually, no, I want to change to December. In December. Okay. When you sell your inventory in December, of course, you're going to be recording a revenue. Okay. For example, $100. Now, at the same time that you're recording a revenue, it is expected that you are also going to be recording the cost of goods sold, for example, $50. So we talked about this last time. So cost of goods sold is usually all the expenses that are required to produce an asset that is going to be sold during the period. So obviously, in order to have an inventory, the company will be incurring, all costs and expenses, for example, employee salaries, electricity bills, or machines depreciation expenses. All types of expenses will be recorded under the cost of goods sold. Okay, so usually all the expenses are recorded in the same period that you are going to be recording a revenue. Now, if this is not the case, for example, if you record a cost of goods sold in January of next year, okay? Now, this makes the financial statement very confusing because you are actually recording a revenue, for example, in year one, but you're actually recording expenses for year two. That doesn't really make sense. It makes more sense if you report both revenues and expenses at the same time, because these expenses and these costs incurred because you're selling that inventory that happened in year one during December. So this is what that means here. Any cost that helps generate revenues, you're going to be recording the expenses in the same period as you report the revenue. Okay. Any confusions? Questions? Okay. So basically, to summarize, you're going to be recording expenses in the same period, that you're going to be recording a revenue. That's it. Okay. And usually in the textbook, this is called a matching principle. Okay. You're going to be matching revenues principles. You're going to be matching revenues with the cost of goods sold and also all sorts of expenses related to the revenue transaction. Okay. That's it. Any questions? Okay. So that's it. Key point is that the revenue recognition principle states that revenue is recognized in the period in which goods and services are provided to customers. Again, upon fulfilling all the obligations, providing services or delivering goods, then you're going to be recording a revenue, and at the same time, you're going to be recording the expenses. Okay. Now, I like to show examples. So let me share this. So let's see what Apple has to say about this revenue recognition principle. I think it's on page 28. So here it says, let me make it bigger. Okay. Well, so according to Apple, okay, according to Apple, the company has 3 types of obligations, okay, when they're selling their iPhones, Mac, iPad, or other sorts of hardwares. The first performance obligation is the hardware component and bundled software delivered at the same time. So what that means is that, let me make it smaller. There you go. So what that means is that when Apple company records the revenue, there are 3 components. 3 components. The first component is the hardware aspect. So when you're selling an iPhone, it is going to be the iPhone sales. That's it. Okay. The second obligation is the right to receive certain product-related bundled services, and the example shown is iCloud, Siri, and Maps. Okay, so when the Apple company sells iPhones, they record separately for the items, for the revenues for iCloud, Siri, and Maps, for example. Okay, so let's say we have $1,000 for iPhone sales. Maybe hardware goes to about $700. iCloud, Siri, Maps goes to $200. I don't know the details. I'm just assuming the ratio. And then the third obligation is the right to receive the future unspecified software upgrades. So basically, the company reports a revenue with respect to the software upgrades. So recently, the company issued iOS 14.2, I guess. So that's proportion is about 100, for example. Okay, so for that revenue, or for that the sale of an iPhone about $1,000, the company breaks this $1,000 into 3 components. Okay, one component is the hardware aspect. The other component is the bundled softwares, and then the last component is the software upgrades. Okay, so I mean, in the real world, when we go buy iPhones or when we go buy a car, I mean, at the face value, it looks like a very simple transaction. $1,000 on iPhone, you might have expected the company might record a revenue of $1,000 for iPhone sales, but that's not the case in reality. The company actually breaks this $1,000 in 3 separate components, and they assign this $1,000 into hardware, iCloud, Siri services, and software upgrades based on the proportion of the services. Now, this revenue is allocated following some formula that they do not disclose in this financial statement, but basically this is the term they use. They use this standalone selling prices in order to allocate the revenue. Okay, so again, accounting principles can be very complicated. So it is your job, whereas it is the accountant's jobs to understand the accounting principle, interpreting the accounting principle, and applying those principles according to the environment, according to how the company operates. Okay, any questions on this?
That means they recognize some of the revenue at different times, like the software revenue over time. Is that? Yeah. Okay.
Yeah. So basically, I mean, at the point of the sale of the hardware, you're going to be recording revenue at the point of the sale. Okay. But for example, software upgrades, there are going to be upgrades at the point of sale, of course. I mean, you're going to be always upgrading, but 6 months after, a year after, there are going to be another software upgrades. So for this particular example, you're not going to be recognizing or recording a revenue, but you're going to be deferring or wait this revenue to be recognized until you provide all the software upgrades. Okay, and that's why this revenue recognition principle is very important. It helps you record the revenue at the appropriate time after you perform all the services that are required. Okay. Any other questions? Okay, so this was an example of an apple. So this was a revenue recognition principle. Same thing, similar idea goes to expenses. You're only going, not only, but you're most likely to be recording expenses in the same period as the revenues are recorded. That's basically it. And the principle is called a matching. Again, it's the matching principle. You're going to match revenues with expenses related to the same transaction. Okay. Number 8, not number 8, page 8. Which statement best describes when expenses should be recorded? So number A, expenses are recorded when paid. That's not the case. B, expenses are recorded the day a company promises to pay. That's not the case. Obviously C, expenses are recorded when the cost is used to help generate or produce revenue. Again, according to the matching principles, you're recording your expenses in the same period that you're going to recording revenues. Okay, that's the. Moving on to the learning objective. So we're going to be making differentiations between accrual basis of accounting and cash basis of accounting. Okay, so this is a table that basically summarizes two different bases of accounting. So according to the revenue recognition and accrual basis accounting, you are going to be recording revenue in the period when you provide enough services and provide goods to a customer. But according to the cash basis, at the point of receiving the cash, you're going to be recording the revenue. Okay, so it's very easy. It's just the timing of the cash receipt and the timing of providing a service that makes the difference between the accrual basis of accounting and cash basis of accounting. Same thing goes here for expenses. You're going to be reporting expenses in the period that you're providing the revenue. But for cash basis accounting, you record expenses when you actually pay cash. Okay. And accrual basis accounting is a GAAP, but cash basis accounting is not a GAAP. So that's the difference between accrual basis and cash basis. Very easy stuff, right? Any confusions or questions with respect to this table? Okay. So I think these are some of the real world examples. So this transaction 6, let's take a look at this. The company provided soccer training to customers for cash, $4,300. So according to the accrual basis accounting, you are going to be recording a revenue because you provided service. Okay, you provided soccer training during the period. So yes, you are recording a revenue. Now, according to the cash basis, since you received cash for the service, yes, you're going to be recording the revenue with the same amount. Okay. For transaction 7, December 17th, the company provided soccer training to customers on account. So using credit card, for example, for $2,000, according to the cash basis of accounting, you are going to be recording a revenue because you performed the service. Okay, so $2,000 of revenue, yes, according to the accrual basis. For cash basis, this is not a revenue because you have not received the cash for the services. Okay, so you do not record a revenue following the cash basis of accounting. For transaction 8, you received cash in advance for the soccer training to be given in the future or in the next period. So according to the accrual basis accounting, since you have not provided service yet, you are not going to be recording a revenue. But on the other hand, according to the cash basis, yes, you're going to be recording a revenue because you received cash, even though you have not provided the service. Okay, so as long as you can differentiate between when you provide a service and when you receive the cash, you can easily distinguish between the accrual basis accounting and cash basis accounting. Okay, easy stuff, right? Any questions with this table?
Professor.
Yeah.
So for the number 8, so the accrual basis. So when we do the journal entry, we're gonna debit deferred revenue.
Oh no, debit. So since you are receiving cash, you're going to be debit cash, $600, and this is receiving cash in advance for the service. So that's credit deferred revenue of $60.
So we, even though we do not recognize the revenue, we still debit cash.
Yes, because we are receiving cash. Okay, when you receive cash, the physical cash, there is an increase in cash.
Okay.
Okay.
Thank you.
And again, this is, even though it says revenue, this is not technically a revenue, this is a liability. You are obligated to provide a service in the future. Okay.
Okay. Thank you.
Any other questions?
Yeah, just a quick
yes.
question about. Oh yes, the other person go first.
Oh, okay. December 23rd, right? Cash basis. So, you know, when we receive cash, that's cash and credit revenue. What about when service is provided?
When service is provided?
So there's no unearned revenue, right? In cash basis?
Cash basis there. But are you asking this?
Oh, yes. Yes.
Oh, so basically, I mean, for cash basis, since you are recording a revenue, this is the journal entry you're going to be recording, assuming that you're going to be following cash basis. Cash 60, credit revenue 60.
So there's no journal entries when the service is provided, right?
No. Because at the point of December 23rd, you are already recording a revenue.
Oh.
There is no earned revenue. There is no deferred revenue. Revenue is just there. So there is no adjusting entries. Okay. And we had another question.
Yeah, just a quick question, but like in this particular situation, we have like December 23rd, we have this kind of deferred revenue, right? If we change that like date to like January 23rd, right? We would what's called debit deferred revenue credit cash. Would that be like the correct kind of transaction if that would happen, or is that?
Hold on. So you're asking, so on January 23rd.
Yeah.
What happened?
Would we recognize that liability for that month?
Oh, so when the company provided the soccer training.
Yeah.
Okay, so in that case, you're going to be reducing a liability, which is deferred revenue, and credit the revenue.
Okay, so like it depends on like if the company decides like on the periodicity of like, I guess if it goes like from per month or like per 3 months and stuff like that, because like in this case it's just like next month over, right?
Yeah. So I mean, usually for, how should I say it? Should we follow? So some company use follow this monthly updates. Some companies use quarterly, sometimes they do semi-annual or annual basis. So depending on when the company makes adjusting entries, the journal entry might be different. But I mean, given this example, assuming that the company provided service on January 23rd, that's when you're going to be recording the adjusting entries by debiting deferred revenue and crediting revenue. Okay. Any other questions?
Yeah, I have a question.
Sure.
Hi. I'm just curious. You said that, no, I mean, it's in the book that cash basis accounting is not supported by GAAP, right?
No, it's not.
And do we learn about cash basis accounting only for illustration purposes, or any other companies use it in real life?
Real estate uses it.
So you're asking the types of companies that follow cash basis accounting?
Yeah.
I mean, for tax purposes. For tax purposes, companies have to follow, not have to, but they usually follow cash basis.
Yeah, but then even for cash purposes, they still record salaries payable, you know, they still accrue salaries.
Yeah, yeah. Again, I'm not going to go into that detail with the cash basis of accounting. For this course particularly, as long as you can differentiate between accrual basis and cash basis, that's all. That's it.
Okay.
Okay. But I mean, just an FYI, for tax purposes, most of the companies follow cash basis.
Okay. Thank you.
No problem. And then I think we had another question. I guess not. Okay. Now, what is this? So far, this was related to revenues. What about on the expenses side? So on December 1st, the company paid 1 year rent in advance for $6,000. So during the month of December, the company does not record an expense or rent expenses because it technically has not used up your rent, but according to the cash basis, since you used your cash to pay for the rent, you're going to recording the entire $6,000 for the rent expenses. For December 6th, the company purchased supplies on account with $2,300. So according to the accrual basis accounting, you're not recording on expenses because you have not used your supplies. For cash basis, you're also not recording expenses because you have not used your cash to pay for the supplies. Okay. For December 28th, the company pays salaries to expenses, $2,800 according to the accrual basis accounting. Since the companies incurred these salaries expenses, you're recording this $2,800 as in salaries expenses. For cash basis, since you use your cash to pay for the salaries, yes, you are recording the expenses following cash basis. Okay. Any confusions with this table?
Well, will you go over the usage of supplies that you purchased for $2,300?
Okay. I mean, let me just quickly write journal entries. Okay. So when you purchase supplies, for example, December 6th, the journal entry you're going to recording is asset supplies. The amount is $2,300. And then this was on account. So accounts payable, $2,300. As you can see, according to this journal entry, there is no expenses related.
Well, then go to let's say you use,
I mean, in case you're actually using your supplies, yes, you are going to be recording expenses.
So do a January, they use like $300.
Mm-hmm. So if you are using your supplies by $300, this is the journal entry. So supplies, expenses, okay, by $300, and you are going to be reducing the asset supplies by the same amount, $300. Okay.
Got it.
Mm-hmm. Any other questions? Okay. Whew. lots of questions. So it gets more complicated as we move on to chapter 3, 4, 5, and 6. It's going to confuse a lot of students. So the key point is the difference between accrual basis and cash basis is the timing. The timing of the cash receipt, the timing of providing service, the timing of selling the product. Okay, so as long as you can clearly identify that the idea of timing, you're not going to be having any problem with cash basis accounting or accrual basis accounting. Okay. Concept check 3.2. Which of the following would be recorded as an expense under accrual basis of accounting? So A, the company purchased office supplies with cash and does not use supplies. So this was basically this. So when the company buys supplies, there is nothing related to expenses. So no, the company uses utilities in the current period, but does not pay cash. So since the company is using the utilities, you're going to be recording utilities expenses. So yes, B. C, the company provides services to customers for cash. So when the company is providing service, that's revenue, that's not expenses. The company purchases equipment by borrowing from the bank. Again, equipment is an asset. Borrowing from a bank is a liability. So nothing to do with expenses. The answer is B. Okay. Which of the following will be recorded as an expense under cash basis accounting? So here, answer is A, because the company purchased office supplies with cash and does not use the cash supplies. So remember from the previous question, it says we have not used office supplies, and that's why we're not recording expenses. But according to the cash basis, when you purchase supplies with cash, that's an expense. Okay, so the answer is A. Okay, so depending on what types of basis you're following, the journal entry might be very different. Okay, so again, the idea is that as long as you can identify the timing, as long as you identify when you purchased something, when you paid off something, journal entry might be very different. Okay. So I think this is about a great time to take a break. I think we covered a lot. So why don't we take a 20-minute break until 7:40? Then next one is basically the adjusting entries. Okay, so 20-minute break. Okay, why don't we resume our lecture? Any questions before we move on to the adjusting entries? Okay, I think there are no questions. Let me just, where's the chat? There you go. Okay, so from now on, we're going to be learning the journal entries with respect to the adjustments, when to record it, and how to record it, okay? Adjusting entries are necessary because you're following accrual basis accounting, and we learned about its timing differences between revenue recognition and cash flows, and with respect to the expense as well as the expenses with respect to the accrual basis and cash basis. So this timing difference is the fact that's causing a problem with respect to the journal entries. So that's why we need an update as time progresses, okay, with the transaction. Now, so here we see a figure. So it looks very complicated. So basically it's this. Let me use, okay, a timeline. So November, December, December, okay? So basically the figure says, what if you pay cash in advance, okay? The great example, okay? The great example is rent, okay? So far, when we pay cash in advance for rent, okay, this was the journal entry that we recorded. Prepaid rent, debit, and credit cash. Okay, let's say $100. Okay, so this was the journal entry that we learned so far. Now, what about the next period when we actually use this prepaid rent or spend or expense this prepaid rent for December? Okay, so assuming that this prepaid rent is for December, okay, what journal entry you're actually going to record to account for the expenses that you used during the period. So this is a great example for an update or for an adjustment. Okay. So this was the journal entry you recorded in November. What about the journal entry you're going to be recording in December? Okay, so it's easy. So debit, you're going to be recording rent expenses because you are actually living in that premise, and credit, prepaid rent by, for example, $100. Okay. So basically, this is an adjusting entry. During November, you incurred an asset, okay, because you're paying something in advance. And during December, when you actually live in that place, you're going to be recording the expense, okay, with respect to the place, and you are going to be crediting prepaid rent to explain that you are reducing the asset to record the expense. Okay. Any question with respect to these two journal entries? Okay. So this is an example with respect to the rent. What about this right side? Receiving cash in advance. Okay. And we talked about this previously. So basically, if you receive something in advance, okay, that you usually record deferred revenue. So for example, November, December. So during November, you are going to recording debit cash, for example, $500. For soccer training, you're going to be recording deferred revenue. for $500 because you have not performed the service yet. Okay, so during December, when you actually perform the service or provide a service, then you are going to be debiting deferred revenue, $500, and you are going to be recording service revenue by 500. Okay. So, I mean, as long as you understand the flow, or as long as you understand the sequence that is going to be followed, it's very self-explanatory. Again, during November, you're receiving cash in advance for the service, and that's why you're recording this liability on obligation. During December, when you actually satisfy or fulfill the obligation, then you are going to be reducing the liability, and then you are recording the revenue. Okay. So it's any question with respect to this timing difference, the adjustments, and follow-up journal entries?
Just one quick question.
Sure.
For like salaries expense, that's an expense. But the prepaid expense, that's an asset. So do we just have to know like which expense is, I guess, an expense versus an asset?
Of course. I mean, salaries expenses. I mean, it's pretty much straightforward. I mean, it's the expenses with respect to the salaries. Prepaid expenses. I mean, there's no other. I mean, for me, there's no other way to interpret it that it's an expense. I mean, it's definitely an asset because you're paying something in advance. Now, in your case, you have to distinguish them, of course, or let me just put it this way. It's very easy. It's going to be much easier if you just memorize these individual accounting line items going forward. Okay. Any other questions? Okay. So this was an example of paying cash in advance or receiving cash in advance. What about this? Okay. What's the good example here? So this is with respect to the salaries. Let me go up. So again, another timeline here, November and December. Let's say this, in the current period, you are incurring a liability. I'm going to use an example of salaries. Okay. When your when your employees are performing services for you, you're going to be incurring salaries expenses. Okay. But you're not paying that salaries in the current period. You're actually paying the salaries in the next period. Okay. So during November, you're going to be debiting salaries expenses by $100 and crediting accounts payable by $100. Or not account. What am I doing? Not accounts payable, but salaries payable. Salaries, I'm going to use P. Okay, salaries payable. This is a journal entry that you're going to be recording in November. And when December comes, you had some payables arising from the last period. So you're going to be debiting salaries payable with the same amount, $100, and credit cash by the same amount. Okay. So this is an update. This is an adjustment that you're going to be following up because of the original transaction. Okay. Now, in reality, not only during December, not only you're going to be paying cash for salaries payable, but also at the same time, there are going to be the same employees working for you. So you'll also be recording another salaries expenses for example, $150 and crediting salaries payable, another $150, $50. Okay, so this adjustment was made because of this in November. This journal entry was recorded for the services performed by the employees during December. Okay. Now, for the next item here, so basically you are providing services, okay, but you're actually receiving cash later on. So when you provide service, November, December, so when you perform service on account, okay, then you're going to be debiting accounts receivable and crediting service revenue by $50, for example. And when the customer actually pays, okay, during December, then you are going to be recording cash $50 and crediting accounts receivable by $50. Okay, so this was the original transaction. This is an update or adjustment. Okay. So as long as you can follow track of what has happened, you can easily write the follow-up journal entries or adjusting journal entries going forward. Okay. So any confusions? Okay, I think we're in pretty much good shape. So like we did previously on chapter 2, there are a lot of examples here. So let's just go through individual transactions. But before we do, so prepaid, so I guess this can address your question. What are prepaid expenses? They are assets that arise when a company pays cash to acquire an asset in advance, okay? So the timing difference arises because even though you are paying cash in one period, you're actually expensing that asset in the next period or in the later period. And that's why, because of this timing difference, there are going to be adjustments following the accrual basis of accounting. Okay, and I think this is an example. So prepaid, so with respect to the rent, the company purchased 1 year of rent in advance for $6,000. So technically that's $500 per month. By December 31st, 1 month of rent has expired. So let me draw a line here. Okay, so we have December 1st, we have December 31st. So on December 1st, when the company pays rent in advance for $6,000, you are going to be recording debit prepaid rent of $6,000, okay? And you're going to be crediting cash $6,000. This is the journal entry on December 31st. Now, as time progresses, as you approach the end of month, you're going to be updating or making adjusting entries. So on December 31st, you basically expensed 1 month of rent. So you're going to be recording a debit of rent expenses by the amount of $500 because the $6,000 was for the 1 year rent. So after 1 month, you're going to be only recording $500. That's 1/12 of $6,000 and credit prepaid rent by $500. Okay, so in other words, if I use a T account, prepaid rent, okay, in the beginning, we report a debit balance of $6,000. After 1 month, we are expensing 1/12 of the prepaid rent, so we reduce by 500. So at the end of December 31st, the remaining $5,500 is the ending balance for prepaid rent. Okay. Any questions? Okay, so this is the original journal entry. This is an adjusting journal entry. As long as just make sure that you are able to differentiate between the original transaction and the adjusting transactions. Okay. What about supplies? So the company purchased supplies for $2,300 on account on December 6th. Okay, so you have December 6th. Okay, the company purchased supplies, so you're going to be debit supplies for $2,300. This purchase was made on account, so accounts payable by $2,300. Okay, at the end of December, a count of supplies revealed that only $1,300 of supplies remains. Okay, so December 31st. So the question is saying, let me go up. Oh, it's not going on. So the question is saying, we had supplies, we had a beginning balance of $2,300, and then at the end of the month, the remaining amount is $1,300. So what that means is that, assuming that the company did not purchase any more supplies, the company used $1,000 worth of supplies. Okay, so as an adjusting journal entry, you're going to be recording supplies expenses for the amount of $1,000, and you're going to be recording supplies credit side $1,000. Okay, so this is an example where we do not provide you the number for an adjusting entry. You have to figure out the amount given the beginning balance and the ending balance. Okay, unlike whereas for previous example, we basically provide you the amount for a journal entry for adjusting journal entries. In this case, we did not provide you the number for adjusting entries, but you have to figure out the amount of adjustments that are going to be made for supplies. Okay, any questions with respect to supplies? Okay. Now it gets more complicated. The company purchased equipment for $24,000 cash on December 1st. So when the company purchased the equipment, you are going to be debit equipment for the original amount of $24,000, and this was made with cash. So it's cash $24,000. Okay. Now, so I have to give you a new accounting item. It's called a depreciation expenses and accumulated depreciation. You might be asking what the accounting name accumulated depreciation is, or what depreciation expense is. So basically, in the real world, let's use a car, for example. Okay. Let's use Mercedes-Benz GLB for the amount of $55,000. Okay, even though the original price for the vehicle is $55,000, after, for example, 2 years, the value of a vehicle decreases. Let's say the value becomes $30,000. Okay. So there's a $15,000 difference. Why is that? Because the value of the vehicle is depreciated. The value of the vehicle was decreased by $15,000. Okay. I mean, it's because of the time, because the vehicle wears off. It's because there might be some accident involved to it. So in order to account for the level of depreciation for the value of the original vehicle, we use this account called depreciation expenses and accumulated depreciation. Okay, so another thing that I want to point out is that up until this question, whenever we used an asset, for example, supplies, we directly reduce the asset or we directly reduce the supplies by crediting supplies here, okay? But when it comes to long-term assets that usually last over 1 year, you do not reduce, okay, the asset directly, okay? Directly. Never, ever reduce the value of an asset directly, okay? So again, for supplies, for inventories, we normally reduce supplies directly by crediting that account. But when it comes to long-term assets, we do not reduce the asset directly. That's just the principle. So what happens is that, for example, in this case, we have an equipment with the original value of $24,000. We use an accumulated depreciation account by, for example, in this case, $400. So at the end of the period, we have a net value of an equipment for the amount of $23,600. Okay. So this is the way we do it. And if you're asking why not directly reduce the equipment, it's just how accounting standards, it's how the accounting professionals came to an agreement to account for the reduction in value with respect to the long-term assets. Okay. Any questions with this?
Accumulated depreciation, is that a asset negative asset
It's
account?
called a contra asset account. Okay, so by putting this indicator contra, that means this accounting item is the one that reducing the value of the original asset. Okay. Any other questions? So why don't I show you what Tesla actually records with respect to the depreciation. I had a page number, but I seems to forgot about it. Oh, there you go. 97. Okay, so basically, the company has an asset called Solar Energy Systems. Okay, so this is the original value, $6 billion and $682 million. There's some acquisition cost that leads to the original value of $67.84, but the company is recording this accumulated depreciation of $723. That's basically reducing the value of Solar Energy Systems. So at the end of the day, the net amount is $6,061 million. Okay, so again, instead of directly reducing the original asset value, we use this contra asset account to account for the decrease in the value, and we have this what is called a net value or book value or carrying value. Let me just write it here. So after accounting for the contra asset account, we usually call it the book value or carrying value. Okay, to indicate that this is a net value of an asset. Okay, so if I go to, I don't know whether the financial statement will say this, balance sheet. So if you take a look at Tesla's balance sheet, you cannot really see the accounts accumulated depreciation, but what you can observe is the net value, net. So basically what that means is that the company actually included the accumulated depreciation with respect to the particular asset. Okay. Any other questions? Okay. So basically, this is the adjusting entry with respect to the depreciation on that particular asset equipment. Okay. So which of the following is recorded with an adjusting entry associated with prepaid expenses? So when we talk about prepaid expenses, okay, prepaid expenses, that means, let me use, maybe using an example is better, prepaid rent, okay? As an adjusting entry, we are using that space, so we are going to be recording the rent expense and then reducing the prepaid rent. Prepaid expenses. So we are going to be recording expenses and credit or reduce the asset that we originally recorded. Okay. Which of the following is equivalent to the book value of an asset? So like I said previously, the book value or the carrying value of an asset is basically equals to the original value of an asset minus depreciation. Okay, so cost of an asset less the accumulated depreciation. Okay, indicates the book value or the carrying value of an asset. Deferred revenue is basically receiving cash in advance for the services to be performed in the future. We talked about this multiple times. I don't think I will go through them again. So the company received $600 cash in advance from customers on December 23rd. So what you're going to do, recording is December 23rd. You are going to be debiting cash, $600, because you received cash, but this is for the services to be performed in the future. So you're going to be recording deferred revenue by the same amount. Okay, by December 31st, 200 of the services have been provided. So this is the original transaction. As an adjusting entry, you're going to be reducing the liability by $200 because you provided the service. So you're going to be recording a revenue of $200. Okay. So at the end of December 31st, what you're going to be seeing in the balance sheet is that originally you reported $600 for deferred revenue, but you decreased by $200. So at the end of the year, you're going to be seeing $400 of deferred revenue in the balance sheet. Okay. So like, as you can see, I mean, chapter 3 is all about these journal entries, making adjustments and updating the original transaction. So as long as you are comfortable with making adjustments, you are going to be in pretty much in good shape. Okay. What about this? Salaries. So I guess a lot of people were confused about salaries, when to record salaries expenses, when to record cash or salaries payable. So by this, I don't think we're provided the full picture here, but let me just draw what's happening. Okay. So, okay. Timeline here, according to this, employees earn salaries for $300. So what that means that the company incurred, okay, salaries expenses for $300, okay, and that is to be paid in the next period. Okay, so as you can see, by December 31st, first, you have salaries payables. by $300. Okay. So during this 3-day period, employees are working for the company. So basically the company owes of $300 during that 3-day period. And at the end of December 31st, the company owes $300 to be paid in the next period. So that's why you're recording this payable for $300. And during the this 4-day window, the company also incurs additional salaries that are payable for the amount of $400. And that's why on January 4th, the company pays a total of $700, 300 plus 400. Okay. So if a company pays an employee $100 per day for a 5-day work week, that runs from Monday to Friday, and December 31st is a Tuesday, what is the amount of salaries adjustment, assuming that Friday is payday? Okay. Whew. So let me just go up. So basically, this is an example of a weekly basis when the company makes the adjustments. Okay, so we have how do I draw this? Let me just draw this. We have Monday to Friday. Okay. So the company pays employee $100 each day. So we have 100, Tuesday 100, Wednesday 100, Thursday 100, Friday 100. And then they pay. Okay? Now, according to this, December 31st is Tuesday. So what that means is that the company incurs Monday salary and Tuesday salary before they close the book. Okay, close the book. So during that week, the company incurs a total amount of $200 worth of salaries, expenses. Okay, that needs to be paid in the next period. So you record salaries payable with $200. Okay. So if we follow just monthly basis, it'll be much easier. But since we are in a weekly basis, it gets much confusing. But as long as you can grasp what's really happening in the last few days, you can easily record a journal entry that is appropriate for the particular transaction. Okay. Any questions on this? Okay. What about utilities, electricity bill or overhead costs? So here from December 1st to December 31st, the company uses utilities for the amount of $900 that needs to be paid in the next period. And that's why you're going to be recording utilities expenses for the amount of $900 that is going to be payable in the next period. So you're going to be recording a liability for the amount of $900. Okay. Now, interest. So interest gets much more complicated because there are a lot of calculations involved. So let me draw a line here. Okay. December 1st, December 31st. Okay, so when you borrow money on December 1st, okay, let's say in this question, you are borrowing $10,000 with 12% interest. So what that means is that every month, you're going to be incurring an interest expenses. Okay, so for the dollar amount, $10,000 times 0.02 because it's 12%, but this is only for 1 month of interest. So that's 100 interest expense. Okay, so during the months of December, the company incurs the next interest expenses for the amount of $100 that is going to be payable in the next period. So that's why you're going to be recording interest payables for the amount of $100. Okay. So what happens during an exam for a lot of students is the fact that they forgot to account for this 1 month worth of salary. So not salary, interest. Okay, so they just stop here, and then for some reason they get the number of 1,200. But keep in mind, or be really careful, that you're only recording a 1 month worth of interest, and that's why you're going to be recording 1/12 of the interest for the adjusting entry. Okay. Any questions on this? Okay. So what that means is that, so when you borrow money from a bank, what you are going to be usually recording is notes payable, okay? And as you are calculating this interest payables, you are supposed to record a separate account called interest payable. But what happens usually is that they just record additional notes payable to explain the interest. Okay, but when you're only talking about interest, you have to come up with a new account line item called interest payable instead of adding more dollar amounts on their original notes payable. Okay.
Professor, just a quick question.
Sure.
So the principal would then go back on notes payable, right?
Mm-hmm.
Okay.
So principal, the original payment will be this cash $10,000, notes payable $10,000. This is the journal entry. Okay. If a company borrows $20,000 on November 1st at the rate of 6% annually, how much interest expense should be accrued at the year-end date on December 31st? Okay, so in this case, you are borrowing money November 1st, okay? The journal entry you're going to be recording is cash, $20,000, notes payable by $20,000, okay? Now, I can write adjusting entries on November 31st and another adjusting entries on December 31st, but in this case, I'm not going to do it this way. I'm just going to go straight to December 31st, and I'm going to show you how, okay? So on December 31st, you're going to be incurring interest, okay? So for the dollar amounts, you have the principal, $20,000, times the interest rate was 6%, times, so from November 1st to December 31st, that's 2 months out of 12 months, okay? So instead of putting 1 here, I'm gonna put 2 months. And that goes to, oh my God, 1%, so that's $200. Okay, so for journal entry, what you're going to be recording is interest expenses by $200 or interest payables by $200. Okay, so technically you can write another journal entry, adjusting journal entry for November 31st, but why bother if you can just quickly go to December 31st to write the interest payables? Okay, so the answer is B.
Hi, can I ask a quick question?
Sure.
So this is the interest component.
Mm-hmm.
However, for the adjusting entries, is it wise to also maybe perhaps amortize the notes payable portion or not? not really.
Amortize. Well, amortize basically means depreciating. But I don't understand why the notes should be depreciated over time.
I think that's a pay down of principal is what he means.
Yes. We don't really do anything with the principal because, I mean, I guess my point is it wise to kind of like amortize the principal component toward the end of the year?
No. I mean, in the real world, I mean, let's say this example show you have to pay back in 1 year. Okay. So let me just put 20 to here. Okay. So in year 2020, November 1st, you are borrowing money for the amount of $20,000. Let's say on October 31st, 2021, you're going to be paying back. So you're going to reduce in notes payable $20,000 and you use cash to pay off. This is the adjusting entry that you're going to be recording next year. I don't see the point of depreciating or amortizing notes payable here. Okay.
Okay, thank you.
Professor, I had another
Sure.
question as well. Separate from that, I was just wondering if, you know, in the previous example, you adjusted for, let's say, interest expense for 1 month, but here you're doing it for 2. Is there a requirement under US GAAP on how frequently or how many times per year you have to record these accruals?
No, there is no rule. Since we are doing this manually, we are going through this process, but in reality, if we use software, computer does this.
Gotcha. Okay.
I mean, we can even do this by seconds when using computer. So by like 55 seconds after, how much is going to be recording under interest expense? Computers can do it.
Gotcha. Okay.
Yeah.
That makes
sense. The drills, right?
Yeah. Thank you.
Yeah. Any other questions?
So this assumes that interest compounds monthly, not daily, right?
Well, come again. What was that?
This assumes that interest compounds monthly, not daily.
Monthly. But we can do it daily. I mean, I can do it. Let's say the company borrow money on November 15th. In that case, I might have to do 45 days out of 365 days. To be more exact. So, I mean, you can do it daily, you can do it bi-monthly, but for the class purposes, for introductory accounting course classes purposes, we usually do monthly basis. Okay. Any other questions? Okay. What is this? So, again, so you're performing a service on account. So you have some receivables of $700 for the services that was performed in the current period. That's it. Very easy stuff. The adjusting entry will be needed for which of the following transactions? Accrued salaries, so salaries expense, salaries payable, cash out, so adjusting entry. Services provided but not billed, so you have some receivables because you provided service. After some time, you're going to be reducing the receivable because you receive cash. Interest accrued on a loan payable, so when you accrue on interest, you have some interest payables that you are going to pay back when you actually pay off the loan. And that's an adjusting entry. So all of these transactions will require an adjusting entries. Okay. Not important. Adjusting entries are unnecessary when transactions do not involve revenue expense activities, transactions that result in revenues and expenses being recorded at the same time as the cash flow. So what that means is that when customers pay cash, pay you a cash for the revenue, there is no accounts receivable here. So no adjusting entry is needed. When you buy supplies with cash, okay, there is no accounts payable. So there is no requirement for adjusting entries, okay? Financial statements. So, I mean, I showed you a sample of financial statement. For the income statement, you're starting with revenues, and you include all sorts of expenses, rent expense, supplies expenses, depreciation expense, salaries expenses. You total the expenses, and at the end of the period, you are going to be reporting a net income of $1,200. If this number is in negative, then you're going to be recording a net loss for that period. Okay. Statement of stockholders' equity. I don't put much emphasis on that statement, so I'm going to skip that. For balance sheet, so you know the drills. You have assets, you have liabilities, and shareholders' equity. Under assets, you have cash, accounts receivables, supplies, equipment. So a total is $40,000. Liabilities, you have salaries payable, deferred revenues, interest payables, notes payables, and stockholders' equity. You have common stock and retained earnings, and the sum of liabilities and stockholders' equity equals 40,000, and that matches with the total amount of asset. Okay, so again, for the midterm, you should be able to prepare these both types of financial statements given the information, given the transactions provided. Okay. Statement of cash flows. For statement of cash flows, I'm gonna be talking about it in chapter 11, so I'm gonna skip that for now. Which financial statement would include a line for net income? So net income, you are going to be seeing it under income statement as well as statement of stockholders' equity. So let me just go back. Here you, under stockholders' equity statement, you have a net income line item here. Okay. Closing process. So we are in the final stage of chapter 3. So what is closing? What is closing? So let me just show you an example of balance sheet. So at the end of the period, December 31st, 2021, this is going to be the ending balance. Okay, what you're seeing here is the ending balance. Ending balance for each line items on December 31st. Just December 31st. Now, in other words, what that means is that these numbers that you see here are the beginning balance, okay, on January 1st here, 2022. This is 2021, okay? So at 11:59 p.m., December 31st, 2021, these are the numbers for the ending balance. Now, on 12 o'clock in the morning on January 1st, 2022, these numbers become the beginning balance of a new period. So the numbers roll over in each period. Okay, for balance, these it's for a balance sheet. Okay. On the other hand, for income statement, the revenue of $7,200, that becomes 0 on 11:59 p.m. December 31st, 2021. Okay, I mean, that makes sense, right? So in the beginning of new year, 1st, 2021, you're going to be starting with a fresh new number, 0 revenues, 0 expenses, 0 net income. Okay, I mean, so that's the difference between balance sheet and income statement. For balance sheets, each line items, the numbers that you see are going to be rolled over to the next period. But for income statement, every number that you see right here will be converted to 0. Okay, in order to have a fresh, clean new income statement line items. So the process of converting every revenue, every expenses in the next period, that's called a closing process or closing entry. Okay, the process of converting everything into zero. And then the process is very easy. You just basically reverse everything that you've been recording here. So we know that revenues are credit balance items. So by debiting service revenue, you are going to be converting service revenue into zero. And on the credit side, you're going to be recording a retained earnings here. Okay. For all expenses, we know that they are debit accounting items. So by crediting everything, you are converting every expense to zero. And at the same time, you're going to be converting to retained earnings. Okay. Same thing goes dividends. When the company pays dividends, dividends are debit balance items. So by crediting dividends, you're going to be converting it to zero, and also you are recording retained earnings. So at the end of the year, what's left over is the retained earnings with a credit balance of $1,000. And we know that retained earnings is a credit balance item. Okay. Any questions with closing entries? So again, it's very simple. It's just basically reversing everything that you've been recording throughout the period. If you have a debit item, you are going to credit them. If you have a credit item, you are going to debit them to convert everything into zero. What's difference is just to put retained earnings on the other side. Okay. So this was the closing entry. Which account would not be closed during the closing process? Routine. I think the answer is wrong. So dividends are closed. It's only the retained earnings. Retained earnings are balance sheet items. So we know that under balance sheet, shareholders' equity, we have a retained earnings right here. This is the balance sheet item, so it's not going to be closed. Okay, so a mistake here. Dividends, expenses, revenues, they're all converted to zero at the end of the period. Okay, so I'll change that. Any questions on this?
Yeah. Why do accountants do income summary instead of retained earning?
What was that?
Like some people use income summary instead of retained earning.
Income summary.
Summary, like to close and then close the income summary to like stockholder equity.
I'm not quite sure what you're referring to. My guess is when you say income summary, I think what you're referring to is just a net income. Okay, so
Yeah.
I guess, so instead of converting everything individually, you would have a net income. So instead of individually converting everything, you just convert just one line item, which is net income. But I'm not quite sure what you're referring with respect to income summary.
No, it's just some people tend to use, like I think back in undergrad, maybe they use income summary instead of retained earning. I was just curious if is there any meaning behind that?
I'm not even familiar with the term income summary here. For my course purposes, don't even bother knowing income summary.
Thank you, but I get it. Same thing, pretty much.
Yeah. Basically, just converting everything to zero. That's the whole point of closing entry. Yeah. Any other questions? Okay. So we are at the end of the chapter 3. So why don't we go over some of the problem sets that are prepared? Okay. So the company prepares monthly financial statements for its bank. The November 30th, these are the balances. December 31st, these are the balances. And the following information is also known. The company purchased supplies in December, total $5,000. The question is asking, recording adjusting entry. Okay, so let's start with some of the examples here. So it's always, so when you are given the beginning balance and the ending balance, I always suggest students to use T accounts. So let's start with supplies. Supplies. So you have a beginning balance of $3,000, okay? You have an ending balance of $4,500. So whatever happened during the period, you had an increase by $1,500. Okay? That makes sense. But the fact is that the company purchased supplies for the amount of $5,000. So instead of recording $1,500, what happened during the period is that the company purchased $5,000 here. So what that means is that the company spent some of the supplies during the period, and we don't know the amount. So if this is a simple math, you are starting with 3,000 plus 5,000 minus x equals 45. So x becomes 35. Okay. So what that means is that the company spent supplies worth 3,500. Okay. So as an adjusting entry, you're going to be recording supplies expenses for the amount of 3,500, and you're going to be recording supplies on credit side by 3,500. Okay. So again, whenever you're given the beginning and the ending balance, I always advise students to use T accounts. This visual aid always helps you with solving questions. Number 2, you have prepaid insurance. So let me draw another prepaid insurance. Insurance starting with 5,000, ending 3,500. According to the question, no insurance payments are made in December, so that's it. So you have a decrease of 1,500. So basically, you're just covered for the month of December. So as an adjusting entry, you have insurance expenses by 1,500. You have prepaid insurance for the amount of 1,500. Okay. Now salaries. Let's look over salaries. Okay, my computer is getting slower. I'm about to buy a new one. So you have salaries payable starting with 13,000, ending is 17,000. According to this, the company paid to employees for the amount of $13,000 during December for November salaries. So the company paid 13,000 during December. Okay, so what that means is that during December, the company incurred additional $17,000 that needs to be paid in January of next year. So as an adjusting entry, you're going to be recording salaries payable on the credit side. Okay, on the debit side, you're going to be recording salaries expenses for the amount of 17K. Okay.
Wait, I'm sorry, that's salary expense 17,000, right?
Yeah. Sorry, my handwriting sucks. Any questions? Okay. So lastly, you had on unearned revenue. Revenue starting with 3,000, ending 1,500. The tenant pays quantum 4,500 in advance rent for the period of November through January. Unearned revenue is credited. Okay, so what that means is that whoa, this one's a bit confusing. Okay, so keep in mind that this is for period of December. Okay, so let me just draw a timeline here. November 1st, November 30th, December 31st. Okay, on November 1st, a tenant pays quantum 4,500 in advance. So at that point, the company is recording cash 45. Okay, deferred revenue of 45. Okay, and keep in mind that this 4,500 is for the month of November, December, and January. So what that means, each month is about $1,500. Okay. So during November, as an adjusting entry, as time passes, you are going to be recording the actual revenue. Okay, since the tenant lived in that place, preferred revenue of $1,500, and then the actually recording a rent revenue of $1,500. And during December, you're going to be recording another adjusting entries, which will go like deferred revenue. Whoa, slow computer here. Another deferred revenue on the debit side, 1,500, and revenue 1,500. This is for December, this is for November. And January, you're going to be recording the same journal entry. Okay. Any questions on this? Okay. So again, slow. So that 40, this one is a little bit trickier because you're dealing with multiple months of rent and you have to make an adjusting entries for each month. And the dollar value for each month may differ from what you are comfortable with usually. Okay. So that was it. Consider the following transactions for that company. Equipment costing $60,000 is purchased at the beginning of the year. For cash, depreciation on equipment is $10,000 per year. How much net income in the net income is higher, lower if the adjustment is not recorded? Okay, so the question is asking, indicate by how much net income in the income statement is higher or lower if the adjustment is not recorded. So we have some language issues here, but let's take step by step. According to A transaction, I don't care about the original purchase, okay? I only care about the adjustments. Okay, for adjustments, the problem actually shows you the amount, $10,000 depreciation. So what you're going to be recording is depreciation expenses by $10,000, accumulated depreciation by $10,000. Okay, now the question is asking by how much net income is higher or lower if the adjustment is not recorded. So if the company fails to record this depreciation expenses, okay, net income, okay, in this case would be higher by 10,000. Okay, because since you are not recording an expense for the amount of $10,000, net income will become $10,000 higher. Okay, that makes sense, right? Any confusions here? Now, on the exam, we tend to trick students. So we usually use a term overstate or understate. Okay, something is overstated, something is understated. Let me just write it clearly, understated. Okay, so given this, okay, since you are not recording expenses, in other words, net income is overstated by $10,000. Okay, that makes sense, right? But when during the exam, when students are nervous about the questions, they tend to overthink or overthink about the questions, and they become a little bit confused about these overstated, understated issues. So as long as you can understand what's really happening here, you can easily answer the questions. Okay?
Just to quickly clarify, just because the depreciation expense, right? When it's like revenue minus expenses, the expenses that are posted to the revenue is just higher, right?
Yeah.
Okay, cool.
I mean, revenues is just there. It's just that the expenses are lower by $10,000 because you're not recording a revenue. If the expenses are lower by $10,000, your net income will become $10,000 higher. Okay. Any other questions? Okay, moving on. According to B, the company lends its financial chief financial officer $80,000. Principal interest at 5% are due in 1 year. Okay, so on June 30th, the company is lending money, okay, with an interest of 5%. So on December 31st, you are going to be incurring an interest revenue here, okay? Now the amount is $80,000 times 5% times from June 30th to December 31st, that's 6/12. So that's going to be, oh my God, so $200. Okay. Is it 200, 2,000? Let me just do. Oh, 2,000.
1,000.
Yeah, 2,000. Okay. Now, again, so far we've been talking about interest expenses, but in this particular case, the company is actually lending money. So what that means is that you have some interest receivables, okay, of $2,000, and you have interest revenue of $2,000. Okay, this is the adjusting entry for the particular transaction. Now, the question is asking if the company fails to record this revenue. Okay, if the company fails to record a revenue, your net income will be lower than the actual by $2,000. Okay, so what that means, in other words, is that your net income will be understated, okay, by $2,000. Okay. So again, the fact that you're not recording a revenue that you were supposed to record, your net income will be lower by the respective amount. So that means your net income will be understated by $2,000. Okay. Transaction C. The company received $24,000 from a customer for a 1-year property insurance policy. Earned revenue is credited. Okay, so what that means is that on October 1st, you're receiving cash, okay, for $24,000. Earned revenue is recorded. $24,000. Okay, at the end of the year, December 31st, this is a 3 months period. Okay. Now, originally, this 24,000 was for a 12-month period. So, in order to account for only 3 months, that number becomes, let me just 24,000 times 3/12. So that's 6,000. So on December 31st, you are going to be recording a revenue. Okay, unearned revenue decreased by 6,000 and the actual revenue of 6,000. Okay. And then if the company fails to record this revenue, that means your net income will be lower by 6,000. In other words, your net income will be understated by $6,000. Okay. Any questions?
Can you just go back to the interest one more time, because like the handwriting just threw me off a little bit.
Sorry, let me just go up. There you go.
Is that interest receivable and then interest
revenue?
Revenue. Okay, cool.
Yeah. Again, so we've been talking about interest payables, interest expenses, but in this case, the company is actually lending money. So we are recording interest receivables and interest revenue. Okay. $56. Ooh, lots of things going on. Record the necessary adjusting entries. Okay. Let me do here. A. On December 1st, the company receives $6,000 that is renting office space from Doppler. The payment representing rent for December and January is credited to earned revenue. So basically, what's happening here is the company receives cash, $6,000, and earned revenue by $6,000. This is for December 1st. At the end of the period, December 31st, this is for 1 month rent. Now, it says this money was for December and January, for 2 months. So after 1 month, you're going to deduct half. So unearned revenue, 3,000. The actual revenue by 3,000. The adjusting entry right here. Okay. B. The company purchased a 1-year property insurance policy on July 1st for the amount of $24K. The payment is debited to prepaid insurance for the amount. Now, in the actual exam or quiz, we're not going to give you this. Okay. We're giving you too much. Okay. We're going to end right here. So what that means is that on July 1st, you are going to be recording prepaid insurance for the amount of $24,000. You're going to be using cash to pay for that insurance. As a closing or no, adjusting entry on December 31st, this is for 6 months of insurance coverage, which is about half of what is shown here. So you're going to be recording the insurance expenses for $12,000, and you're going to be reducing prepaid insurance by the same amount. Mm-hmm. So again, this $24,000 was for a 1-year coverage. After 6 months, when you're actually closing your book, you are going to be making adjusting entries for the period of 6 months. Okay. And again, stop me anytime if you're confused with anything. Transaction C, salaries of $30,000 for the month of December will be paid in early January. So that's easy. So you are incurring salaries expenses during December for the amount of $3,000. That amount is payable because you're going to be paying them in January next year. Okay. D. November 1st, company borrows $20,000 from a bank. A note is signed with the principal and 12% interest to be paid on October 30th in the following year. So what's happening here is that on November 1st, you're borrowing money. So you receive cash because you're borrowing money for the amount of $20,000 and you have a liability, okay, $20,000. Now, after 2 months, December 31st, you are incurring an interest expenses. So we know that interest expenses will be debited and that interest will be payable next year, okay? Now, the question is the dollar amount. We have $20,000 times the rate is 12%. Again, this is for 2 months of interest. So 2 over 12. So that's $400. Okay, so interest expense for $400, interest payable of $400. Transaction E. Office supplies at the beginning of the period is $1,000. The company purchased additional $2,000. By the end of the year, the company has $500 remains. So let me just use T account. You have supplies. In the beginning, you have $1,000. During the period, the company purchased additional $2,000. I don't know how much they used the supplies, but at the end of the period, $500 is remaining. So what that means is that during the period, the company spent supplies worth $2,500. So taking that number, I'm going to be recording supplies expenses for the amount of $2,500, and you're going to be reducing supplies by $2,500. Okay. So any questions on this? Okay, no question. I think we're good. The revenue recognition principle states that companies typically record revenues. Again, when companies record revenue, you had to have provided enough service or provided goods to customers. So in the period, there you go, in the period in which we provide goods or services to customers, that's when you record revenue. When customers order goods, no, that's not the timing when we record revenue. When we receive cash, no. When goods and services are prepared to be sold, I don't even know what the statement is talking about, okay? We only record revenue when we provide goods or services, okay? Under accrual basis of accounting, companies typically report expenses. So according to the matching principle, expenses are recorded in the same period when you record the revenue. So here, in the same period as the revenue they help to generate. Okay. On the cash basis of accounting, companies typically record revenue. So on the cash basis, you record revenue when you actually receive cash. So here, in the period in which we receive cash from customers. Okay. On May 5th, company receives a phone call from a customer needing a new water heater and schedules a service visit for May 7th. On May 7th, the company installs a new water heater. The company pays for the service on May 10th. According to the revenue recognition principle, on which date should Johnson record service revenue? Again, you record a revenue when you actually perform the service. Now, according to the statement, on May 7th, the company installs the new water heater. So the date of the service is when the company records the revenue. Okay. On November 1st, 2021, company received cash $6,000 from customers for the services to be performed evenly over the next 6 months. Deferred revenue is recorded at the time, which of the following adjusting entries is needed on December 31st. So here you have November 1st, receiving cash $6,000, unearned revenue of $6,000. So again, this $6,000 is for a 6-month period. So what that means, each month you're going to be recording a revenue of $1,000. Okay, so at the end of the period, December 31st, this is after 2 months. So you're going to be recording unearned revenue of $2,000 and the actual revenue for $2,000. So on December 31st, debit unearned revenue of $2,000 and credit service revenue of $2,000. Okay? Any questions? So again, chapter 3 requires a lot of practice and a lot of exposures to various types of transactions. So I really strongly encourage students to go back to your textbook and try to attempt to answer as many questions as you can before the midterm and before the quiz. Okay? So again, we don't have any questions?
Professor.
Yeah.
So we record that the earned revenue on on December 31st, 2000. Does that mean we didn't record anything on the November 31st?
Yes, I mean, again, this is one way, or another way is on November 31st. What you could have recorded is unearned revenue 1,000, the actual revenue 1,000, and on the date of December 31st, same thing, unearned revenue 1,000. Yeah, the actual revenue of 1,000. I mean, you are just repeating yourself, and if that's the case, why bother repeating yourself? Just combine everything all together into just one journal entry. That's the point.
Okay, thank you.
Also,
any other questions?
Professor, you mentioned the quiz. The date for that has not yet been announced, right? Okay.
No.
Thanks.
Yeah. Any other questions? Okay, so if we don't have any questions,